From 2020 to 2025, that housing wage has grown $10, over $10. That is insane.
It's not like a big factor. It might help a little bit.
There aren't that many sellers because people are reluctant to sell.
Right now, nearly half of your household income, 43%, is going straight to your mortgage. It's a staggering number that we've never seen this high in modern U.S. history. Not even during the most intense days of the 2008 housing bubble did we face this level of financial strain. And what's even more shocking is that this number isn't just a problem for a handful of people. It's affecting entire generations of would-be homeowners.
It's not just sort of building affordable housing, it's building housing that the average household, especially people buying for the first time.
The policies of the past few years didn't just make buying a home harder. They raised the bar so high that it's no longer even within reach for many of those who would otherwise qualify. If you thought the housing market was tough before, you're about to feel the full weight of the reality. Homeownership has never been more unattainable. This crisis goes beyond just a headline or another round of statistics that sound alarmist. The truth behind these numbers is even uglier than what you see on the surface. Some economists have estimated that it could take anywhere from 10 to 15 years of steady income growth to return to even a baseline level of affordability, assuming, of course, that home prices don't continue to rise during that time. Imagine that. Imagine working hard year after year, and yet your paycheck is still not enough to close the gap between your income and the sky-high price tags on homes. In real terms, that means you're stuck watching the dream of homeownership slip further and further away from you, no matter how disciplined or diligent you are in your savings and planning. This isn't just about high prices. It's about a system that is fundamentally broken.
That when we make financing more flexible in this way, it's more buyers going after the same number of homes and prices will go up.
The math no longer works for most people. With mortgage payments now swallowing a staggering 43% of the average household income, it's a far cry from the historical norm, which hovered around 25 to 35%. Before the 2008 housing crisis, affordability was already stretched to its limit at 41.5%. But today, we've blown past that threshold. And it's clear that the causes behind this shift are far more complex than simply rising prices. This crisis is rooted in the combination of stagnant wages, soaring home prices, and escalating interest rates, none of which show any signs of improving anytime soon. As a result, millions of would-be homeowners find themselves locked out of the market, no matter how hard they try. Take Sarah, for example. Sarah is a 29-year-old in Austin who has spent the last 5 years diligently saving 20% of her $50,000 salary. She thought she was doing everything right, saving aggressively, keeping her credit clean, and staying disciplined. But as she got closer to her goal of buying a home, the market just kept moving further out of reach. Every time Sarah thought she was close to pulling the trigger, the market shifted again. Home prices jumped, inventory evaporated, interest rates climbed, and her rent increased by 25%. Meanwhile, inflation eroded the value of her savings. Each time she tried to catch up, she fell further behind. This isn't a rare case. This is the story of a whole generation of buyers who thought that discipline and hard work would lead them to homeownership, only to discover that the system had changed in ways they couldn't keep up with. The response from policymakers has been to point to tightened lending standards and the elimination of risky loans as proof that things have gotten better. There are no more subprime loans or ninja loans, they say. But the cold reality is that credit is not the issue keeping people out of the housing market.
The thought of our best option being a 50-year mortgage and we're paying our mortgage off still in our 70s and our 80s, it's really discouraging.
It's the gap between wages and home prices. The cost of owning a home is now so far removed from the average person's income that the math just doesn't work, even with the availability of low down payment options, like FHA loans, with just 3.5% down, or VA loans that offer zero down payments. Home ownership is still out of reach for most people. Why? Because the mortgage payments on even a modest home are simply too high for most people's incomes to bear. Lenders may be willing to approve loans, but they won't help if the loan doesn't fit within the household's budget, even if you technically qualify for a loan. If your income can't cover the monthly mortgage payments and still leave room for groceries, car payments, and retirement savings, you're still locked out. So what's the fix? Experts like Sean Dobson, CEO of the Amherst Group, argue that getting back to affordability would require an economic miracle of sorts. Specifically, 3 highly unlikely scenarios would need to occur. Home prices would have to drop by at least 35%. Mortgage rates would need to fall back to the near 2% levels we saw in the early 2020s, or household incomes would have to skyrocket by 55%. Let that sink in. A 35% drop in home prices, mortgage rates crashing down to historic lows, or wages growing at a rate far faster than the economy has seen in decades.
What we need to do in this country is reset our economic policies so our economy works for us, for ourselves, the British people.
None of these outcomes are remotely realistic in the near term. And even if any of them happened, it's unlikely that the effects would be felt soon enough to make home ownership a viable option for today's generation of would-be buyers. After the 2008 financial crisis, the U.S. government overhauled the mortgage system, tightening lending standards to prevent the kind of reckless lending that caused the crash. But in doing so, they inadvertently shut out millions of would-be buyers, particularly those with less than perfect credit scores. This is a point that Dobson is quick to emphasize. The lending system now favors people in the top 25% of earners, leaving the rest of the population out in the cold. To put it simply, if you're in the bottom half of earners,
Most people who are renting here in Utah are spending over 50% of their income on housing.
traditional lending options are no longer available to you, no matter how hard you've worked to save. It's not because you're unqualified. It's because the system is now rigged to favor those with larger incomes and higher credit scores. This has created a situation where millions of Americans who would be fully capable of making monthly mortgage payments are excluded from the market entirely. And as a result, institutional investors have filled the void. Private equity firms, large investment groups, and corporate landlords have flooded the market, buying up homes and pushing home prices even higher. What used to be a system designed to help people achieve the dream of homeownership has now evolved into one that actively restricts access for many. Dobson, whose company Amherst is one of the largest institutional landlords in the U.S., argues that institutional buyers are stepping in to fill a much-needed gap.
The economy needs to be run for consumers and for employees. For the last 30 years, there has been a shift towards the interests of chief executives.
Without their involvement, many working-class families would have no access to decent housing. But while these institutional buyers provide some stability in the market, they've also contributed to the skyrocketing prices that make homeownership unattainable for most people. However, the real problem with institutional investors is that they don't solve the issue of homeownership. They merely shift the burden. They provide rental options, which can be helpful for some, but they don't address the broader issue of affordability for would-be buyers. While institutional buyers are filling a market gap left by the absence of affordable homes, they are also pushing prices higher and driving regular buyers further out of the market. The reality today is that the typical American has almost no chance of owning a home. Policies that once made home ownership attainable have now made it all but impossible for most people. The dream of owning a home has become a fantasy, and the dream of upward mobility through real estate has been replaced with the reality of perpetual renting. The problem is not simply about high prices or rising mortgage rates. It's about a systemic failure to create an economy that can support home ownership for the average person. With wages stagnant and the cost of living rising, it's no wonder that so many Americans feel locked out of the housing market. While some experts push for government intervention, the reality is that no quick fix is on the horizon. What can you do now? If you're among the millions who feel stuck in this broken system, there are still things you can do to improve your chances of home ownership in the future. While there's no silver bullet to solve the affordability crisis, you can take proactive steps to put yourself in the best possible position when the market eventually shifts.
Savings account and cutting those unnecessary expenses to help grow those savings, and then using down payment assistance programs, looking around for them. There may be more of those than you expect.
Start by focusing on your savings. Build a solid emergency fund that can protect you from unexpected setbacks and give you the flexibility to act when opportunities arise. It's also important to keep saving for a down payment, but don't let your savings stagnate. Consider putting some of your savings into low-cost index funds or other diversified investment vehicles. This will help you grow your wealth and outpace inflation, putting you in a better position to buy when the time is right. Next, look beyond traditional home ownership options. Co-buying with friends or family members, tapping into shared equity programs, or taking advantage of first-time homebuyer grants or co-ops can all provide ways to make home ownership more affordable. Many cities and states offer assistance programs for first-time buyers, so make sure to explore every option available to you. The market is constantly changing, and flexibility is your greatest asset.
If you can afford to buy now, then you can refinance in 3-4 years' time, reduce those monthly costs, and I think sort of be in sort of a better.
If you can't afford the type of home you want today, that doesn't mean you won't be able to buy one tomorrow. The housing market has its ups and downs, and with the right preparation, you can take advantage of those shifts when they occur. There's no denying that the current housing market is a mess, but it's also true that the system is far from static. The policies that have made home ownership nearly impossible for many people won't last forever. Change may take time, but it's coming. Whether that change comes in the form of new government policies, shifts in interest rates, or a collapse in home prices, the future of the housing market will eventually open new doors for those who have prepared and stayed adaptable. For now, the best thing you can do is stay informed, stay flexible, and focus on building your financial foundation. The road ahead might be tough, but it's not impossible. If you felt frustrated, overwhelmed, or shut out, know that you're not alone. You're part of a generation facing unprecedented challenges in the housing market, but with the right approach, you can still make your dream of homeownership a reality. Stay ready, stay engaged, and when the market cracks open just a little, be ready to jump.